When this rally is over, I think we're going to see a secular bear market take hold. One of the reasons is going to be the debt problem. The bottom 30 to 50% are already under significant financial stress. It's not like you're going to have a handoff. When the top 10% stop spending or cut back on their spending, the other folks aren't going to be able to pick up the slack. People don't sell because the market's expensive. That's the reality.
It's Wednesday, January 14th, and today the S&P and NASDAQ are both down 1%, but the Treasury yields are also down. Importantly, Russell 2000, the small caps are up, gold is up, and Bitcoin is up nearly 4% on the day. So is there a great rotation happening right now? Is this the top for large cap stocks? We'll find out with our next guest, Jim Welsh, founder and author of Macro Tides. This episode is sponsored by Kalshi. It is a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. New users will get $10 when you deposit $100. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. More on that later. Jim, welcome back to the show. Good to see you.
It's great to be joining you again, David, and Happy New Year.
Happy New Year to you as well.
It's not too late to do that, right? I mean, we're still in the window.
No, I think the rule is first time you speak to somebody in the new year. So could be in July. We're still happy. Yeah. Jim, last time you were on the show, you said the market was topping. We're nearing a topping phase. We're still kind of in this grind upwards, although today, broad sell-off in large cap stocks, S&P 500. We'll talk about a rotation, possible rotation in just a bit. But is today's sell-off more or less in line with your general macro overview, or do you think it's just sector specific? We did see some weak earnings in financials and tech today.
Yeah. Again, one of the things I look at and rely on, David, is the advanced decline line, because it has historically been really helpful in identifying intermediate and, of course, major tops in the market. And as I've been pointing out the last couple months, is the AD line is making new highs. Historically, that's very constructive for the market. Today, for instance, the QQQ was down about 1%. The Russell 2000 was up 0.7%. You had 800 more stocks up than down. So under the surface, there's a fair amount of resilience. And normally when that's happening, David, you get corrections, but they're typically, 3 to 5% variety. So to me, what's going on under the surface in the near term, in the next few months, I think is constructive.
Constructive. Let's take a look at some of your work right now. So you mentioned that you look at advanced decline lines. Let me just pull up a chart here that I think is from one of your recent newsletters, if I'm not mistaken. And we can just take a look at this together, and you can comment on how you're analyzing this pattern, Jim.
Yeah, basically the bottom panel is the New York Stock Exchange advanced decline line. And for those who may not be familiar with it, it's nothing more than a running total of how many stocks went up today minus the number of stocks that went down. So as I noted earlier, there were 800 more stocks up than down. So the advanced decline line is a running total. So today's number will be 800 issues higher than yesterday. It's making new highs. Back in 2021, the AD line made a high in November of 21. The S&P made a higher high in January of 22. I noted at the time that was a negative sign. We were likely to see a decline. Last year, the AD line didn't confirm the new high that was being made in February, and it set up the sell-off that we then saw in response to President Trump's tariffs. So I can go back to like 1928, 29. So the AD line is a really helpful indicator of getting an idea of the intermediate term and longer term outlook for the market. And as I always point out to people, the market's very overvalued. It doesn't matter what you look at. But David, as long as the AD line is acting healthy as it is, it kind of tells me that the odds are of a major correction is not likely, outside of some kind of a crazy event that none of us can predict. So to me, this is constructive, and it implies that, yes, we could see a pullback in the S&P 500 like we did today, because the top 41 AI-related stocks comprise 47% of the S&P. So you do have this huge concentration, and if that sector gets weak, that becomes problematic for the S&P. And what we saw was compounded today in the sense that money was coming out of one area, but going into another. The problem is when you have money coming out of the market and it's just going out of the market, not rotating. So to me, this looks constructive. And until I see real deterioration in the advanced decline line, I think one has to be positive about the market. And the other thing I'll add is the next time we're going to have a correction, I'm going to be focused on the Russell 2000 because it has taken over a leadership role. And, you get corrections when the leaders take a breath. And, so I think the Russell 2000 is going to continue to work its way higher.
Well, let's just get your year-end outlook. So this is from Kalshi. It's a prediction platform. And traders are predicting that, let me just refresh this. By the end of 2026, the S&P will close most likely somewhere between, the meat of the distribution is in the center, 7,200 points to 7,800 points. So traders overall are still moderately constructive to outright bullish. Does this more or less, before we get your take on some of the tail end risks, does this outlook more or less sit with your own expectations, Jim?
Yeah, I think, again, it's like we're driving a car, David, and what we try to do is look out the windshield, and as the road curves, and of course, we've never been on this road. This is new, right? We just look at the windshield, and if we have to go to the right, we adjust the steering wheel and so forth. So to me, year-end estimates like this are cocktail fodder. And I think that's their value. What I will say is, from an economic standpoint, and I did send you a chart of this, and I've written about this, if you look at what's underlying in the economy today, it's in pretty decent shape.
Yeah.
Consumer spending is holding up well. The tax bill that was passed in Congress with the lower tax rates, the refunds that are coming, that should add about 0.7% to GDP, especially as we get to the second and third quarter. Artificial intelligence spending should add close to 1.7%. Mm-hmm. And then the top 10% of wage earners, David, they spend almost 50% of all spending, and they're doing really well. So it's difficult for me to see over the next 3 to 6 months any reason to expect that the economy is going to weaken materially, which then means underlying earnings should be reasonably positive, maybe not up 12 to 14%, which I think is the guesstimate. But if all that kind of happens, I think the first half of this year, it's hard to see anything major coming to derail that scenario.
So if you look at this distribution, there's an equal chance that the traders are placing on the S&P going down to 6,000 versus the S&P going up to above 8,200 points. 5% chance to the upside, 5% chance on the downside. Let's just take the downside first as an example. What would need to happen for the S&P to retrace 6,000 points, let's say?
Well, you'd have to have a really good reason to sell. I mean, that's one of the things that I think technicians sometimes don't fully understand is you can get sentiment be wildly bullish. And for the most part, these numbers reflect a Wall Street that's really pretty positive and constructive about the outlook. So in order to have the S&P peel off 10 to 15%, there has to be a good reason. Normally, the economy is one of the more consistent reasons why the market would go down. The other reason is monetary policy. Well, to me, the Fed is more likely in the next 3 to 6 months to do nothing. The economy seems to be okay. Inflation will work its way down very gradually. We can talk about that in more detail if you like. So I see policy not ramping rates higher, which is another main reason why the markets have historically, like in 2022, the markets got hammered because the Fed aggressively raised the funds rate. So those historically, David, are the two major reasons why reasons to sell materialize. And again, it's remembering that this business is long biased. Institutions hold for 3 to 5 years. Individual investors are told by their financial planners, buy and hold, buy and hold. So you really need something to challenge a constructive outlook to get people to swivel and say, you know what, it is in my best interest to do some selling. So Is it possible? Yeah, you could get that. But again, it's not going to happen out of the blue. People don't sell because the market's expensive. That's the reality. Now,
That's
when a good
that's an
reason to
excellent point. Yeah.
sell, yeah, I mean, if a good reason to sell materialize, and I mean like recession is obviously a good reason to sell, and you have that coupled with an overvalued market like we saw in 2000, less so in 2007, but it still was expensive. The S&P lost 50%. Same thing in 1973. You had a deep recession, inflation stuff. So you really, for me, that's where technical analysis is helpful, is because I got to come up with a reason to sell. And then, I want to look at the technical underpinnings. And if they're healthy, it means that the market has the capacity to absorb some selling pressure. And, right now, that's the way it's set up. It has the capacity to absorb some selling pressure.
Well, I want to show this chart that you've also prepared. Major trend indicators, long-term trend is positive above the blue line.
Yep.
What happens when we reach a certain point? It says here, expect 3 to 5% correction, and it says earlier, expect 7 to 10% correction.
Right.
Can you just explain some of these lines here?
Okay. Well, first of all, the major trend indicator is a proprietary indicator I put together. It goes back to 1928.
Yeah.
And much like the advanced decline line, it weakens prior to price weakness. And, kind of the all clears above the blue line. It's positive above the green line as well. So what I saw last year was the advanced decline line wasn't confirming the new highs in February. The major trend indicator was starting to roll over below the blue line. And I thought there would be a good reason to sell because I thought Trump was, serious about raising tariffs and that investors would have a reason to sell. So this is just kind of confirming that the underlying trend so far is resilient, and it leads me not to expect any kind of a meaningful decline, which I would say is greater than 7%. So, the technical underpinnings right now suggest decline should be somewhere between 3 and 7%.
What do you think are some of the major macro drivers that investors like yourself need to be watching for in 2026? Is it inflation, Fed policy, geopolitics, something else?
Well, geopolitics we all watch, right? At the same time,
is it really, sorry to interrupt, is it really important though for an investor, given that Trump's been threatening to invade left and right and nothing's happened with the markets, at least stock markets?
Well, again, that's why it actually has to happen.
Sure.
So my point is that grabs headlines, but until something really takes place, it's just like, okay, it might happen. So that always leads me back, since I can't predict that stuff, is go back to the fundamentals. As I said, monetary policy is positive in the sense that we're not seeing rate hikes. The economy's in decent shape. Now, one of the risks, I think, is treasury yields. Here's an ironic twist. Let's say the Supreme Court says, no, you can't do all those tariffs. You got to return the money. Well, that's about $330 billion to $360 billion that the government's collecting, which is lowering the deficit. So perchance, if they say you can't collect all that money, how's the bond market going to react? From a standpoint of, that just means that much more supply. So that to me is one of the things that I'm watching. I think the dollar, if it can break out above 102, that would be, I think, coincident with treasury yields going higher. So those are the two, I'd say, things that I'm really looking at as being a risk, that could potentially offer a reason to sell in not a big way, a correction.
And importantly, we have here a possible rotation into the small caps from the large caps, like you mentioned to me offline, and I mentioned at the beginning of the conversation. Yeah. We have here a situation where the Russell, I believe, is up on the day. Let me just double check. Yeah. And the S&P is down
0.7%.
Exactly.
And the Qs were down, 1%. I did send you, David, a chart of the Russell 2000 going back the last 4 years, showing relative strength, and it provides a bigger picture. Because, as you know, for the last 2-3 years, the Russell 2000 has been underperforming, especially after ChatGPT came out in November of 22. And so what we've seen is a long-term underperforming relationship between the S&P and the Russell. And now in the last few months, that long-term, it's like a saucer bottom, is starting to curve up. We just saw the Russell 2000 break out above the November 21 high, and the high we saw last year. So technically, there's a lot of positive things going on here. And part of it is too, if the economy's in decent shape, small cap stocks should be okay from an economic standpoint. Two caveats. Almost 40% of the small cap stocks in the Russell 2000 don't make money. So, and the stocks in the Russell that have gone up the most so far this year, David, are those exact companies. So I would say that if I wanted to play the small caps, I would look to IJR. It's the small cap 600, and it's a little bit more discerning in terms of the stocks and companies that are in there, and the majority of them are, in fact, making money.
Yeah, IJR is up 13% on the last 6 months versus 10% on the S&P 500. Okay, do you think that the fact that small caps are catching up signals the end of the bull run, if indeed we see historically maybe small caps catch up towards the later part of the bull run and plays catch up at some point other than the beginning? Does that signal the end for you, Jim?
I'm not going to look at it that way, David.
Okay.
Because, again, as long as things like the advanced decline line and so forth are continuing to confirm, the underlying action in the market, I think that's constructive. And I don't see anything, I just mentioned about the Russell breaking out. Well, if it suddenly reversed and dropped below the breakout, which I think was maybe 2,500, I'm trying to remember exactly, that would be concerning. So as it stands right now, I wouldn't look at the action in the small caps as being, okay, this is the death knell. Again, you have money not leaving the market. That's when the market has problems, not when it leaves one area and then moves into another. So it comes down to what is going to cause money across the board to leave the market. And those conditions aren't with us right now.
Let's talk about the economy itself. This is an interesting chart here. Traders are placing a 46% chance of a U.S. credit downgrade this year, by the end of the year. So I'd like you to evaluate. I mean, the national debt is going up. The deficit is widening. Trump has just announced, by the way, a $1.5 trillion defense budget, which is a 50% increase from where it was before. So clearly the Defense Department, or I guess it's called the Department of War now, is anticipating some changes globally, should we say. That to say, how do you view the fiscal situation of the U.S. today, and do you agree with this outlook, nearly a 50% chance of a downgrade in credit this year?
Yeah, I mean, I don't know if it happens this year, David, but let's just step back and look at the overall fiscal health of the United States. It isn't good. It's getting worse. So if you look at debt to GDP ratios, we've kind of surpassed the levels that historically have been troublesome for economic growth. Interest expense is moving up aggressively. The government has to, I think, roll over about $9 to $10 trillion this year. And I think one of the reasons President Trump is trying to get the Fed to cut rates significantly is they want to fund that with short-term debt. Because as it stands now, when they roll over paper from 5 years and on, all that paper was previously funded when the funds rate was way lower than it is even right now. So, the underlying fiscal problem is, I think, a serious problem. I think it's going to result in meaningful changes in terms of how we proceed as a country. And I think the next 5 to 10 years, my take is when this rally is over, I think we're going to see a secular bear market take hold. One of the reasons is going to be the debt problem. And there's a lot of other reasons. I mean, you've got Social Security, Medicare, both, scheduled to run out of money, I think, in 2033. That's not that far from now. So there's a lot of things that have been kind of pushed to the side and under the rug, so to speak, that are building problems. And unfortunately, when you get to a secular bear market, it's like you not have one problem, you have many problems that kind of come to the fore.
What do you think of the wealth effect and its relationship to consumer spending? If it's indeed true that the market continues to grind higher, valuations expand, well, what we're going to see is a rich get richer. They're going to spend more money and prop up the economy. So the economy is just going to continue booming. Does that make sense, Jim?
Up to a point. I mean, again, there's a limit to everything. All good things must end. And right now, that's a good thing. Back in 2010, Ben Bernanke, when he was chairman, said the Fed was going to begin targeting asset prices. As you might remember, after the financial crisis, economic growth was really lethargic. So they thought, you know what, we're going to do things like QE to goose asset prices. And they have indeed do that. So now the top 10% is 49% of spending. There's a two-edged sword there, obviously. If and when we see a meaningful decline in the market, and I think housing prices are, in fact, going to be coming down, slowly but surely that will erode the confidence in the spending habits as some of those people at the top begin to get a little bit more cautious. And the bottom 30 to 50% are already under significant financial stress. It's not like you're going to have a handoff. When the top 10% stop spending or cut back on their spending, the other folks aren't going to be able to pick up the slack. So that's the vulnerability that I think will happen somewhere over the next 2 to 3 years. It's coming. It's a question of when do we see asset prices come down? Bear markets are a fact of the world. That's what happens. So we're going to have another bear market. What's going to trigger it would probably be the usual suspects, in terms of the economy slows.
Sure.
For whatever reason, a recession, fears about a recession, PE ratios that are really high get compressed, earnings start to soften, and all of a sudden you're down 30%. The top 10%, I think, will cut back on spending when and if that develops.
Jim, before we talk about housing, which is important, we'll talk about how mortgage rates have come down and how that's going to affect the housing market this year. You've been analyzing the markets for decades. Tell us, do you think the American living standard today has changed dramatically from, let's say, you were 20 years old or just starting, just exiting high school, for example? Think back to when you were in high school. Think back to now. Yeah. Do the kids in high school today have a different standard of living or perhaps even job opportunities than, let's say, when you were in high school?
Yeah. No, it definitely has changed, David. Before, if you went to college and got a degree, you pretty much were going to find a decent paying job. Back when I was in high school, it was a while ago, we still had a very strong manufacturing sector. So a lot of middle class people were working in factories and they were making a decent wage, and their children expected things to be better for them as well. A recent survey, I can't remember if it was Pew or Gallup, because I've written about this, about people losing faith in the American dream. And if you look at the numbers that they came up with, David, and it was in one of my recent letters, the baby boomers still had the most faith in the American dream and capitalism, and those with the least were in their 20s. And I get it why Mondani got elected in New York. For people in their 20s, they aren't living the dream. They came out of college with a degree and debt, and the degree is in something that isn't probably very marketable. They're living in their parents' basement. And so for them, capitalism is an abstraction that isn't improving their life. And so when that happens, people turn to, well, maybe this other thing is going to be better. It sounds good. So I think that what you're describing and talking about is a real phenomenon for the younger people, that are, let's say, less than 30. Because their personal experience hasn't reinforced the idea that I'm going to be able to get ahead. And that is a challenge. The average age of a person buying a home is 40 years. But you want to wait to have kids until you're 40, So there's a lot of fundamental factors. Housing, the unaffordability of housing is a huge challenge. And the solution is unpalatable. The solution is prices coming down.
Well, how do you get ahead in an age where affordability is a literal crisis?
Well, I still think a college degree is of value, but you have to be in the, getting a degree in 14th century literature or, some other humanities stuff. There's not a market for that. If you think about the educational system too, we're fewer kids are being born in this country, significantly different from 2007 and before. That means you don't need as many teachers. So there's a lot of things that are coming together, David, that I think are pressure points on the U.S. economy, and some other countries in Europe have an even more severe problem. I mean, for the first time since World War II, France's population declined. Whoa, that's kind of meaningful. So these are all issues that are not easily solved. And the Fed just cutting rates isn't going to get more babies to be born, and so forth. So
the government's trying to do something about this. One could argue that invading Venezuela is one way for the Trump administration to bring down costs. If you import oil from the world's largest oil reserves, then potentially the price of oil collapses in the U.S., and that's good for the regular consumer. Yeah,
that's helpful. But offsetting that, David, is the price of electricity, which is going up fairly meaningfully. I think it's up, about 30% in the last 4 years or something, for like 14 cents to 19 cents in kilowatt hours or whatever the number is. So you have offsets there. Yeah. So, for a lot of people that are relying on electricity for most of their living, it's great to have gas come down. But energy as a whole is about 4% of GDP. In the 70s, it was 8%. So Is it a help? Absolutely. But is it going to make or break the course of the economy? I don't think so.
And just recent news, Trump wants to cap credit card rates at 10%. What do you think of this?
Well, on one hand, it'll be helpful before the midterm election, which, again, the issue about affordability, in December, when the Democrats started talking about affordability, and Trump's response was, that's a hoax. Well, here comes the guy then said, well, why don't we have 50-year, mortgage bonds? And why don't we have $200 billion, Fannie and Freddie buy $200 billion of mortgage back to get yields and mortgage rates down? Credit cards, let's slash it to 10%. Well, will that be helpful? I think last year, David, the interest expense on the plus $1 trillion plus in credit card debt was $250 billion. You cut it in half, is that going to be happy? Yes. What is the repercussions? Well, guess what? The credit card companies say, fine, you want us down to 10%? Then we're not going to extend credit to risky borrowers or questionable borrowers. So what happens to credit? It contracts. Is that a healthy thing for the economy? No. So there's political expediency happening, and I get it. The midterm election, historically, the party in power loses a lot of seats, and the cushion here is less than 5 for the House.
Yeah.
So I think there's some measure of also wanting Powell to cut rates. I think that's part of that equation too. Let's get rates down. Let's get the economy even stronger, so that we can brag going into the midterm elections. So I think that's what may be driving the calculus that's driving all these initiatives, David. But there's, I think, some negative economic repercussions from, on the surface, Elizabeth Warren would be happy cutting it to 10%. But if you're a marginal borrower, and now you don't have access to credit card debt, you're going to go to the payday loans? Or Joe down the street, who breaks knees if you don't pay.
Is the Fed still cutting
negative consequences to some of the things that he's talking about?
Is the Fed still cutting rates though? Look at this, Jim. So 350 to 375 basis points is the current target rate. The market is pricing in basically no chance that the Fed's going to cut anything by the next meeting, which is in exactly 2 weeks from now. March meeting, not looking great either. 73% chance that Fed does nothing. And then the chance increases somewhat further out you get. But this seems to have moved a little bit since the last couple of days and weeks, especially since last Sunday, Federal Reserve Chair Jerome Powell issued a video statement talking about how the DOJ is coming after him specifically for criminal investigations only because, according to Powell, he refused to cut rates like Trump asked. He's making this a 100% political statement. We don't know if that's really the case. Maybe the DOJ did suspect something independent of what Trump has done in the past and pressured the Fed to do in the past. But anyway, what do you make of that legal battle back and forth between the Fed and Trump? And by the way, I believe a DOJ investigation, criminal charge investigation to a Fed chair and president. And what do you make of that story? And generally speaking, your outlook on monetary policy this year?
Okay. Well, that's a handful there, David. Okay. In the January macro tides, I kind of break down. If you look at the Board of Governors, there's 7 people on that. And potentially, Powell's term ends in May. So he'll have an opportunity to appoint someone there. He already has Chris Waller and, Sue, whatever her last name is, that he appointed during his first term in office. What happens with Lisa Cook, obviously, is another potential seat. So there's possibly a chance that he could have 4 to 5 of the seats on the board. And what I talked about in the January macro tides is if you look at the way votes are done, the New York Fed is always a voter. Then you have 4 rotating seats from Fed district presidents. 2 of those 4 are pretty hawkish. So my point is the idea that Trump is going to get all these people on board and they're going to do exactly what I want, I think is a little naive. I mean, I'd like to think that these folks, and I do think that they have integrity. So I think the risk of what President Trump is doing is if people really lose confidence in the independence of the Fed or its integrity, are you going to be a big buyer of Treasury bonds? Mm-hmm. I don't know. To me, that would be a reason why you might want to hold back a little bit. Yeah. Because, the risk of there being more inflation, if he gets what he wants, is obviously higher going down that road. So I think it's counterproductive. I think there's Powell can stay on the board until 2028. So to me, there's the risk that you keep pushing on Powell, and he may say, "Okay, I'm going to hang on for another 2 years, just because I believe in the independence, integrity of the Fed, and I'm going to be one of the people who stands up." So there's a downside to what he's trying to do, David. And I think the whole probe thing it's like, wow, there's never in the history of Washington, D.C. has there been a construction program or a social welfare program that didn't cost more than estimated. I mean, so to me, that puts this whole thing about, the cost went from 1.9 to 2.5 billion. Should it be looked at? Absolutely. Is Powell responsible for that? Oh, by the way, labor costs have gone up significantly. Material prices have been going up. So I think, again, it's political pressure that I don't think there's a lot of upside to it. I really don't. I would have taken a different tack. Now, should the Fed be criticized? Yeah, they've been wrong a lot in their history. That stuff is warranted. David Rosenberg went through all the Fed, the summary of economic projections for many years, and what he found was that the projections for GDP and the funds rate and all that were right about 35% of the time. Now, you think about it, the Fed doesn't control the economy or inflation or the unemployment rate. They do control the funds rate. Going back, the December of 2021, the SEP for that year came out and they said, we're going to raise the funds rate 3 times by a quarter point. They wound up raising it, in 2022? How much did they raise it by? It was over 400 basis points. So, again, are they a target to be criticized in terms of past performance? Absolutely. But I just personally, I really do believe these folks are serious and do have integrity. And is there some political bias? Hey, they're human beings. So,
okay. Yes. Well, the last thing I want to bring to your attention, which you touched on slightly earlier, is the U.S. mortgage rate. So let me just share my screen now, if I may. The mortgage rate here has fallen to the lowest level since 2022. Contract rate on the 30-year mortgage dropped 7 basis points to 6.18 in the week ending January 9th.
Yep.
Okay, what's going on right now? The Fed funds rate is falling, but this is falling even faster. What does this mean for the housing market this year?
Well, what's happening, David, is the spread between mortgage rates and the 10-year Treasury has narrowed by, I think, 45 basis points over the last 6 months. So that's part of it, and the Fed bringing rates down a little bit is another part of it a little bit as well. I don't think, I've written about this, and in the January Macro Tides, I talked about Reef Insight did some analysis, and they went back for 10 years, David, and they looked at median incomes, median home prices, median mortgage rates by state. So it was very detailed. Their conclusion was that in order for affordability to become, positive again, the mortgage rate would have to drop to 3.68%. Housing prices would have to drop by 29%. So so what's happening with mortgage rate, is it a plus? Absolutely. Also, the University of Kansas did analysis from 2000 to, I think it was 2023, by county or another incredibly detailed. And what they found is if you look at population growth and housing being built, there was no shortage. So, the one thing that we're always told is, well, there's a short of housing. And what that did is at least make it question the degree of shortage there may be. And maybe it's not anywhere near what people are suspecting. I mean, you got a lot of baby boomers that are going to be moving on, and that housing is going to come on board. And you've got a group of people who can't afford to buy a house. Yeah. Because they can't save money. Rents are so high, wages aren't growing maybe enough, and so forth. So to me, that sounds like a mismatch over the next decade of supply versus demand. And I do think housing prices are going to come down. Other thing I'll note is begins with a Z. What's the real estate outfit? Anyway, in just this last month, they said in 50
Zillow.
Yes, thank you very much. For 400, no, I'm just kidding. Sorry. No, in 53% of the U.S., housing prices fell an average of 9.7%. So we're already seeing under the surface pricing weakness. And if you get more supply, I think that's going to be a death knell. And if and when we ever do have a recession again and unemployment goes up, now you get some forced selling from that. You're not going to get forced selling like we saw in 2008 and 9 and 10, because only 4% of all the houses, based on their last transaction, are below the price that people paid. So you have a huge cushion between where current prices are and where people bought them. So you can see a decline in prices, David, without generating forced sales. But we talked earlier about the wealth effect. If my house loses 10 to 15% over the next 3 years, am I going to feel wealthier?
Yeah.
No. Yeah, but all that kind of stuff really does take time.
This has been a great talk. Let's close it off here. Tell us where we can find your work, though, and people want to know more about your indicators and read about your research. Where can they go, Jim?
Yeah, two things, macrotides.com, but more specifically, if you send me an email, jimwelshmacro@gmail.com, I'll send you the January Macro Tides that covers some of the stuff and even more of what Dave and I have just covered, and happy to do that. And I'll send you a weekly technical review, which goes out every single Monday and looks more specifically at price levels for the dollar, treasury bonds, gold, and stocks.
All right. We'll put the links down below, so make sure to follow Macro Tides there. Thank you so much again, Jim. Thank you for coming back on the show. Welcome back, and Happy New Year.
Hey, thank you, David. Really enjoy our conversation. You ask good questions, and it's always great to be, having a conversation with someone. So thank you.
Appreciate it, Jim. And don't forget to follow Jim in the description. Links in the description down below. Don't forget to subscribe and like this video. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users get $10 when you deposit $100 in your first trades.